Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Wednesday edition of Trader Talk in today's market. I am your host, Kevin Horner. Beautiful sunny morning here in the Denver metro area today on this fine Wednesday. Pleased to be joined by my friend and fellow Schwab coach, Brent Moores. Good morning, Brent. Good to see you as always. How are things?
It is good to be here, Kev. I missed the last couple of weeks with you, I think, and there's been a hole in my life. So I'm glad to be back here. My routine has been off. I'm back to normalcy. Of course, with the Monday holiday, everything's still kind of messed up for me. I'm like, is today Wednesday? I can't remember what day it is. But anyway, it's great to be with you, Kev, and I'm happy to talk about the markets.
As am I. Thanks for being here, of course. Yeah, we're going to cover a number of details this morning, and the market just continues this melt-up move that we've had over the better part of the last 6+ weeks. And, it's been enjoyable. Hopefully, we've all been managing it properly, sticking with our positions as long as possible. But, we'll talk about the trend, and we'll see some of the shifting currents that are kind of leading the market higher here. So we're going to talk about plenty of that with you all today. As always, on a Wednesday, we're joined by our fellow coach and friend Barb Armstrong there in the chat. Say hey to Barb. She'll get to comments and questions Brent and I are unable to, but we keep an eye on things for you there nonetheless. Please feel free to post for the duration of our show. We go about 45 minutes total here, everybody. So, and then finally, if you're not doing so, just make sure you're giving us a follow on your preferred socials. I'm available on X, Kevin Horner CS, Brent, of course, Brent Moores CS, and Barb Armstrong CS. It's a good spot to find us when we're not hosting classes for you here on the channel. And with that, let's get to the disclosures and we'll get to the chart. So first of all, keep in mind that everything we cover for you today should be considered informational and educational only. We're not making any recommendations here, nor any endorsement for a specific approach to trading the market. We do encourage you, however, to consider technical analysis merely one of your decision-making puzzle pieces, not the entirety of it, of course. And we discourage you from making decisions based exclusively on what you get in the way of technical analysis. What we do bring to the table in our discussions of the broader markets with technical analysis, though, are just concepts and strategies traders may choose to use. You get to kind of fine-tune those decision-making ideas, though. Those are entirely at your discretion, so please make sure you're doing your own due diligence. Now, if you are new to our class, our agenda takes a top-down approach to review of the market. That means simply we start with indices, then we look at subgroups like sectors, industry groups, etc., before moving into stocks in the news. And with that, we're going to take a look and kick things off with the S&P 500 here. So Brent, I've been talking a lot about the work we've made with the 20-day moving average, but for a lot of this rally, Brent, it has been the 10-day that's been kind of the most consistent of our trend following detail here. What have you been watching?
Well, I I've been watching just the trend going up. The 10-day is just showing the strength of that trend. And throughout the time, I've thought, is this going to continue to go up? My brain says, no, it probably shouldn't. Or maybe my heart says it shouldn't. But my brain says, I've been indoctrinated with the trend is your friend. And
Yes.
until we start getting breaks of not just the 10, the 20, and showing not the higher highs and higher lows, then we're going to consider it a trend. And so it doesn't matter what junk you see going on in the world or whatever. And we've actually maybe had some more positive news the last few days, but we're going to use a technical analysis here on that. And we've just seen this strong trend, whether you're using a 10-day or a 20-day. I don't know if it matters. I think they're saying the same thing, to be honest.
I think you're right. The reminder here is let's not fight against what's happening. And further, as you said, if we rely on price action to dictate how we manage our trades, well, you've been basically offered a process by which you would have largely stayed invested in the S&P 500. The same can be said about the NASDAQ and the Russell as well. It really comes down to how we individually feel as we're watching trend and managing it. The reason I say that, Brent, is because we've had that whole 1 day close here below the 10-day, just one. And some of you may have seen that as a reason to lighten up S&P 500 or S&P 500 proxy positions simply because we had a close below the 10-day. And that would be fine.
Yeah.
I'm not here to tell you that that was a
Right.
wrong decision if it made you comfortable to stick with the remaining shares or dollars you had invested here, Brent. Trade management is really a huge part of what we cover in this class.
Yeah, in hindsight's 2020, who knows? We didn't know
Right.
it was going to bounce there. And so you just got to use something that a system and an organized system to try and help you manage your trades. And closing below a moving average may be a time to adjust, tweak something, move a stop, take some of the load off a little bit. And ultimately, maybe you have more cash in that case. And in the case of some other future pullback, you'll be able to allocate it. Or maybe the close below a moving average isn't just to move to cash. Maybe it's to move to a different asset class of some sort or something like that. You can keep your
Sure.
money invested in something else. I mean, I guess cash technically is an asset class, but just a different part of the market, different sector, different a commodity, fixed income, whatever however your system is.
Yep, exactly that. Traders will often move profits out of winning trades little by little, piece out here, take a chunk of profitable dollars, apply it to a new trade that is a different setup and ready to go. Very, very common approach that traders take, especially for those of us who prefer to be involved where the market's giving us opportunity to stay involved. It's really hard to deny the rally we've seen. There will continue to be narrative denial here, Brent. That's one of the key components, of course, to bull markets. We frequently get the negatives, right? The narrative that says this is ridiculous, it can't continue. Is this a valid move? So on and so forth. And Brent, even as I'm going to move us to the Nasdaq, but I think the topic still is valid here, which is essentially, how do we evaluate whether we have more upside, or does it really matter until and unless the trend breaks? I'm not so sure that it does.
I don't know it does either, because I'll tell you what, if you go back to say, I don't know, not April, yeah, April, fourth month, 420 is what kind of where I'm looking
Okay.
there on the graph.
I see it.
And you're going there, I'm saying, wow, this market is extended. This is crazy high. That's what it seemed like probably at the time. And I suspect that wasn't just for me, because if you think what was going on at the time on April 20th, so this was just a month ago, a little over a month ago, the war was still in full force, still inflation concerns, and there was a lot of concerns in the market, and the market had just gone up. I don't know what it was from the bottom to that point right there, but up 10% or 20% or whatever like that. I'm thinking this is overbought. And sure enough, and it's not just this case. I've been in the markets for, oh Lord, I don't know how long, Kevin, 30 years or so. And over 30 years actually now. But I've done this over and over and over again. I've seen this situation where the market doesn't make any sense to me, but it does something different. The technicals kind of can help you guide the way. Now, the technicals aren't the only means of market analysis. Just to
Right.
get that straight, there's some great fundamental analysts out there. There's other things that can affect the market, but technical analysis is accessible, and it can be helpful, I think, for us people at our money management and a systematized approach to the market.
I think that's the takeaway. If you are finding yourself battling against the narrative of the market, oh, I can't understand why the market goes higher. I don't know if I can buy into it. I don't know if I can believe in it. Well, then really watching price action might actually be the best process for you as a trader. If you're having that struggle in deliver or believing in the market's ability to continue higher, well, you're not alone. But the way that many a trader will manage that is simply reliant on the price action to dictate their decision making, and further splitting up the entry of investments and the exits on their trades, right? Splitting them up because it helps us to manage the emotional tie we have. Unfortunately, that caveman brain we all have is very similar for all of us as traders, and it tends to keep us from wanting to admit our faults, right? Wanting to admit, oh, I was wrong to step in at this point, therefore I should be a seller. That latter part, the idea that I should be a seller because I was wrong, well, that leads you to the completion of the idea, which is, okay, I'm admitting my fault. I'm admitting I was wrong. We tend not to want to take it to that end, which is often why we traders find ourselves holding losing positions, because we don't want to admit that we were wrong along the way. And that's where management becomes so key. I talk about this quite a bit in that class I offer on Tuesday afternoons, the Building a Stock Portfolio, because that is all about allowing our positions to hold, let them do what they're going to do, and we just elevate and raise stop orders along the way as a means of protecting ourselves. It's the hardest part. You're absolutely right, Mike. The psychological aspect to management of our trades. That's what we hope to bring to you here in this particular class. Demystification of everything like that. Give you ways to balance and challenge the caveman thinking process, Brent. It's not easy, but if we all admit it, I think it becomes a lot easier, right?
Admitting it is the first step there. I've heard that before on other things too. But yeah, so I don't want to belabor the point too much. We're not saying, last thing, we're not saying you need to stay fully invested in the market right now at this level. But just I won't repeat what we've said there. Use the technicals to help you guide you.
That's the idea. We use them as best we can, and then key is how do we manage it for ourselves. We're all very different in that way. So a lot of the same stuff on the NASDAQ here. 20-day could work, 10-day can work. Recent highs can work. So if we make a high today, as we have, and some of you traders will wonder, well, what does today's candle speak to? Obviously, we'll see how it looks at the end of the day. But remember, some traders look to the most recent high. And then if we trade below the low on our high day, some traders on a closing basis become a little bit more profit-taking mode, so to speak, right? They maybe take a little off as things may pause. Always pay attention to that concept there. Now, we're going to move over to the Russell and expand a little bit here, Brent, because the conversation on small caps always and frequently, at least in this class, carries us to the yields and so forth. So we're going to expand a little bit. But Brent, this was a fantastic snapback, wasn't it? Right off of horizontal support. I often say it, matching lows are cool. Lower lows, not so much. And that's exactly what we got here. We had a low here. We matched it right here. Happens to be horizontal support coincident with prior highs. Back here, all of this bodes favorably now that we've seen us make new highs from that level.
Yeah, significant support level there. And that's why we look at them. And it doesn't mean that it's destined to always bounce off that. But when you see, look, there's a lot of support levels you can draw all over the place if you wanted to. But the more bounces off a particular level, generally the more credence we would give to that as a support level. And so that was kind of a key one there. And the chart looks a little different than the large cap indices, but the gist of it, the general upward trend above the moving averages, same deal in that regard.
It is, and granted, once more, trend management here, everybody. If you were below the 20-day for a few days as we were, you could have been forgiven. Totally would have been given the go-ahead to lighten up on any of these moves. Now, if you were forecasting it and you're here on the first day and then you're here on the second day and you're thinking, okay, should I be reducing position now? Some of you would say yes, and you'd be feeling pretty good about it on day 3. But of course, if you were thinking, hey, we broke the trend line, the dynamic moving average, should I be looking for horizontal support to hold up? The answer to that is perhaps. And of course, it's easy in hindsight. I know that. I am by no means a perfect prognosticator, nor do I wish to be, because the truth, I mean, that's not true. Of course I want to be, but that's almost impossible as it relates to technicals here. The idea is, under the 20, should we look to the next layer of support, and should it be a moving average or horizontal? And I think given the shakeup we saw in this area, Brent, we should have been thinking, hey, this is a potential zone for a horizontal test of support. If you were prepared for it, Brent, you may have been willing to act on it. And even still, if not, that's fine, because the very next day was a bit more of a clearer heads up. Would you agree in terms of management there?
Yes, I would. And now let's say we've had the last 5 days or so, we've gone up. At the time, what we were looking at is we were looking at rates that were spiking.
Yes.
And I'd submit that likely if rates hadn't reversed themselves, we probably wouldn't have seen the bounce that we saw. Yep. So for example, if we bring up the TNX here on this, so this is the 10-year yield, and you look at the last 5 days or so, what we've seen is it's just gone down. I don't think it's a coincidence that we've seen the reversal on the rut while the TNX has dropped. And because, and we've said this before, small caps tend to be much more interest rate sensitive than large caps. Now, it can affect the whole market, but small caps especially so. And for a while, small caps did kind of defy what rates were doing, and they were still going up even though rates were going up. But at a certain point, there's kind of a breaking point where the higher rates can really do some damage to the market. And we were starting to get to that point where a lot of that narrative was coming out from quite a few quite a few pundits, so to speak, I guess. But I think that that's what we're seeing. And so the technicals can be driven by macro events, news events, fundamental events. And I think that's kind of what we're seeing here. A little bit of a relief on the rate front there, because we were up close to 4.7%, I think.
Yeah,
and,
we were 4.6. I mean, the high here, Brent, was 46.87. So we slide that decimal, 4.687, pretty darn close. And you're absolutely right. It was the move up, but it was the move through 4.5 that really concerned us, I think, broadly, and that's what led to that deeper pullback in the Russell. Now we're back below 4.5, below the 20-day moving average for a day. We'll see how that looks at the close today, but that is a significant development. Brent, one final thing on the yield here before we shift over to something else, but horizontal, this is a validation of the bullish trend in yield. If yield were to get a bounce here, this would not be a shock based on at least the technical perspective of this pattern.
Right. And I'm glad you brought this up, because a lot of times with the RSI, when people are looking at the RSI, there's kind of this simple view of, hey, if it's above 70, it's overbought. If it's below 30, it's oversold, which isn't, those are important considerations. But there's a lot more you can do with the RSI. And there's other technical indicators like this you can use, like but a MACD or whatever. You can look for support levels on it. Also, depending on what the market's been doing in an upward trend, and I think this is something you brought up in your wonderful webcast you teach on Tuesdays at 4 o'clock Eastern time, by the way, is that with the RSI, if you've been trending up and you go down below, say, the 50 level, that can be kind of an oversold area. That can be considered kind of an oversold area. It doesn't need to get all the way down to the 30 level in that. So there's some more subtlety you can use with this RSI rather than over 70 overbought, over,
Yep.
below 30 oversold level. So I'm glad you brought that up there on this.
Thanks. Now, just quick looking at the last time we pulled back to that zone, everybody, you can see the yields found support, and that was at the midline here, right at that 50 zone. It's a little more of a range as usual, so we'll talk. 45 to 55 can be your oversold condition in strong bullish trends, and in strong bearish trends, 45 to 55 can be the overbought condition that you're looking for to validate pullbacks that have run into areas of resistance. So always be willing to massage, so to speak, the RSI expectations. That'll give you a little bit more clarity. And I've seen a couple of posts in here about the movement in oil. I definitely want to address that. It's definitely been a big reason that we've seen the yesterday's rally in particular. So let's talk about it. Now, we're going to use a future symbol, but we're not encouraging nor suggesting futures trading. We're using this just as a means of understanding the trend. And that's really the takeaway here, Brent. Taking a look at crude, we fell out of this consolidation. Now, I call it a consolidation because we had a huge rally, and then we've just gone lower highs and higher lows. Well, we fall out of that now, Brent, and a lot of traders are wondering, is this the significant development we've been waiting for? And of course, we've got the headlines out there. We know that there could be some semblance of clarity on the conflict coming to a conclusion. Maybe this could be the beginning of that phase, Brent, but the break is the significance. That's probably got the reasoning for the tailwinds we felt yesterday.
Yes, and this is another indication of like how technicals may the market is, and in this case it's the oil market is making a forecast in a sense.
Yes.
And whether whether you think it's the war is wrapping up or not, the market thinks there's some brighter horizons, I guess, on the war front there. Yeah. I have no idea what that's going to look like, but that's what the market is. From the technical standpoint, that's a significant break. When you have that consolidation like that, the traditional technical analysis interpretation is if it breaks to the low side, it's more of a bearish signal. If it breaks to the high side, it's more of a bullish signal. Bullish in terms of the commodity or index you're looking at. In this case, bearish, you may consider that to be good because that could potentially lead to some lower oil prices. Now, we've seen this as we've looked at those oil futures out into future months, how there's a difference there in the price. And you can see that when you look at those, because what it does is it shows what the futures contract prices out into the future. And when the future months are showing lower prices than the existing, the more near-term one, so you can just look at like the last column there at the top, you can see, oh, it's 89, 86, 84, yeah. 81, 79. You can see now that's not as big a difference as it was, but because the front month has actually come down now. But you can see market expectations are that oil is going to be cheaper in 146 days, in 118 days, in 85 days than it is now. Now, is it going to be as cheap? Does the market think it's going to be as cheap as it was before the Iran conflict started? No, it doesn't. If it did, then we'd see a last price down, what was it, mid-60s or something like that.
Yeah.
There. So higher for longer. We've talked about higher for longer with rates, higher for longer with oil, even if things do turn out to be much better on the Iran front, the prediction is oil is going to stay high. Not as high as it is right now necessarily, but
that's exactly it.
Higher.
You nailed it. It's not that it's going to stay as high as it is now, or at least that's not how traders are positioned, but that it's going to be higher than it was before the conflict. And there's two different concepts there, right? Because a lot of that current price, if we lose 12 to 15% per barrel in the price, yeah, you're going to see the market likely take that as a boon, as a positive, of course, because lower oil relative to what we've seen, right, is disinflationary. We've had inflationary pressures, so if inflationary pressures, give in and we get less inflation, well, that's a positive. Obviously, that's a good thing for the market. This is going to be a potential tailwind for the broader indices here. Now, we can talk about oil's movement on a short-term basis. It'll impact our charts every single day, obviously, especially with significant moves. But we should also mention, Brent, there's been some headline detail here out of some of our most prominent analysts. So, for example, Goldman Sachs today lifted the S&P 500 target to 8,000 now. They're not alone. Morgan Stanley and Deutsche Bank both see a year by which we complete a 17% return in the SPX. Currently, our SPX return year to date, as I shift this over, is almost 10%. Now, 10%, that is a very strong, standard, great return. It is not the 25% we've been seeing over the last 3 years, for example, but by no means is that a negative. That is a great year. I thought that this was a big heads up because, Brent, they just keep pushing out expectations. That is a positive for us as well.
That is a positive. And I think they said, this is driven by earnings and expected future earnings, that there's going to be a lift from AI and chips and just earnings across the board are a strong tailwind for the economy. 17%, given all that we've had, it's a forecast, so it's not,
right,
nothing in stone here. But given all that we've seen in the world, that's surprising to me. But that's what the prediction is, and so far the market has kind of played out in that way. Now, one other thing we should probably mention, and that is, we've said, well, the market seems to be forecasting that the oil prices are going to be going down. That's a drag on the economy when they were going up, and it should boost. So does that mean the market's going to go way up because oil prices go way down? No, not necessarily, because the market's forward-looking, and the market itself is kind of proof of that, because there's no reason the market should be doing overall what it's been doing unless it were expecting better, a brighter future than what we've been seeing, because there hasn't been enough, at least in my opinion, to warrant the market going up as much as it has, unless it was willing to look kind of beyond the conflict in Iran a little bit. So it wouldn't surprise me to see a little bit, let's say we do get a good resolution with the Iran situation. Yes, we may see a little spike, but the market may not go up as much as you may expect, because a lot of that may be priced in.
That's another great reminder of market psychology, right? A lot of that gets built into price action before it actually happens, and then we see the result, and then people take profits from there, because commonly the average retail investor is the one who's late to the game, and they come in on the news, so that creates liquidity for those that were there already, and they look to unload their profitable positions. That's a very common way that plays out. K. Brown, I noticed your comment here about hey, analysts, this is not what they were suggesting in January. You're absolutely right. They do ultimately make their adjustments, but typically, these analyst firms, they make their adjustments based on the data with which they have to work. So new data comes to the table on a quarter-to-quarter basis, then we have new information, and then they can start forecasting things a little bit differently, of course. Brent, one of the other things we got to look at here, I just think that speaks to what we're seeing in the market. I want to continue to use future symbols for these next few, but I wanted to point out that gold and silver both are just not moving. The so-called fear trade is not prevalent right now, everything is leaning towards equities, continuing what they've been doing. It's why you're not seeing gold move and you're not seeing silver move. And again, we're just using these as future symbols just to get an understanding of trend. But you can see the trend pretty clear here, can't we, Brent?
Yeah, and you know, you have a choice as an investor, and institutions have a choice as investors as to where they put their money. And you can put it in equities, which has been paying off quite well for them, you know, to this point at least. And uh, so less, if there were more concerns, then it's probably likely you'd see it go to more towards precious metals. But right
Sure.
now, the equity market is working just fine. Thank you very much. And therefore, why put extra money into gold? Now, there's other reasons as well, but that, I mean, that could be. I think that's the choice of where to the money goes in the market, because it always goes somewhere, is a big reason that gold and silver have been kind of stagnating. I don't know the right
Yes.
word here for you.
I think that works. That truly works because we saw immense pressure to the upside. And of course, it takes a while for that pressure to release and then validate new price levels, right? We're basically in price discovery mode. It's
Yeah.
not negative. It's not like they are bearish charts. They're both holding and maintaining 200-day moving averages. But the reason I bring it up, Brent, is because these two are very different in what they tell us about the market versus something like copper, which tells us something about the health of the economy. And
Yeah.
you can see a very different breakdown here when we look at copper.
Yeah, the copper chart's quite bullish, unlike the other charts we were looking at. You can see the support line that we tested. Is that the 10?
The 20.
That's a 20-day moving
Yep.
average. The 20-day moving average, we've maintained that for, you know, a few months now, and that's a strong sign on copper. Copper's an industrial metal. It's can be kind of a predictor in a sense that the more strong the economic forecast, generally, the stronger the copper market is. And if you have a weak forecast for weak growth, then you tend to see copper decline.
So this is a positive as it relates to the health of the U.S. economy and the need for industrialized metals like this one, which is so prevalent for such a specific approach to our economy, right? Copper is needed in everything that we do. So as copper rises, it tells us that there is a defined need for it, and that kind of speaks to the health of the economy broadly, without getting too much more specific. But you called it out. Bullish chart, pulled back to an area of support. Looks like it continues to remain bullish. We'll see if it holds that 20-day moving average going forward. Brent, we're seeing some, if we talk about the action we see in the sector relationship, the move in oil has led to a continuation breakdown here in energy. So again, our defensive groups are falling by the wayside. Energy to the downside. We've also got, how about financials kind of struggling a little bit, improving chart as I've defined here with my drawings, but staples, and excuse me, here's, let's see, staples is, there it is. We're getting a bounce today. We got rejected though. So as we saw a little bit of this optimism come back into the market, Brent, I thought for sure we were going to see more downside in staples, but maybe we're seeing the longer range development play out here, holding the 50 days. Does this maybe give us some instruction on perhaps the enthusiasm of technology, semiconductors, so on and so forth? Holding a 50-day on staples, does that tell us something maybe?
Yeah, that is interesting, isn't it, Kevin? Because generally when the market is, what we've seen is we've seen a lot of good performance out of more discretionary elements in the market. So, for example, the discretionaries have been up over the last month, about 3.5% or so. And IT and communications, these kind of more cyclical type sectors. And so typically when you see that, what you see is that staples and the more defensive ends of the market are kind of lag. But actually, this has held up relatively well. We've seen a little drop here in this, but all in all, the market is seeing some, broader optimism, I guess, not just solely focused on IT and semiconductors and the stuff that we
Exactly.
talk about all the time.
And I don't take that as a negative. I just take that as a reminder that we traders, we can get outside of the tech trade and
Yeah.
probably find other ideas and opportunities. Don't be of the mindset that the only place to trade is tech. In fact, Brent, the other group that I've been talking about it, at least in my webcasts and on Twitter, just changes to a 20-day. Look, we've got tech at the lead. You've got communications rallying nicely today, discretionary up again today. But as of yesterday, healthcare was number 2 on the return over the last 20 days. Healthcare has held up pretty well. And notice here, this brief little drawdown from meeting resistance is holding the 200-day here. So maybe there is a reminder in play here that as we see the short-term trend in technology maybe get a little bit tired just due to the move we've seen, you're going to see some of these other laggers start to step in and provide some leadership shorter term.
Yeah, as technology goes up, then people have valid concerns about valuations on technology, whether from a technical standpoint of just overbought or
Mm-hmm.
from a fundamental standpoint of uh, price earnings ratios or things like that. So um, so you start to see people diversify. We talked about this before. When you go to a certain level, sometimes what you do is you don't get out of the market entirely. You just kind of shift where it goes,
Mm-hmm.
where your money goes, because there's always a choice of where your money goes. And if you feel the IT run has been enough that you want to diversify somewhat out of it, maybe, where does the money go? And that's, some is going into healthcare, it seems like, and some even into staples, perhaps.
Perhaps, yeah. I think the reminder I want to give is simply there are other areas that can be working, some of which are going to be in bottoming formations. Remember, if we've had a group struggle like healthcare or staples, and they're finally coming off of those lows, you're going to find some interesting opportunities within those groups that might be turning the proverbial corner after having been in maybe a 9-month, 12-month, 18-month downtrend. And when they turn those corners, it's when you get maybe the better opportunity to be in an extended position, a swing trade, so to speak, where you find yourself buying nearer those recent bottoms and you get the opportunity to stick with something for a couple of months to maybe 4, 5, 6 months or longer, just simply because of the timing of your willingness to devote money. Now, that's not necessarily the way that a so-called trend trader goes about it, right? We like if you're a trend trader, you're looking for stocks already in uptrends, making higher highs, higher lows, and giving you the areas to expose money along areas of support. But if you are a willing participant who is looking at those groups that could outperform in the near run, this is the kind of analysis we encourage you to be doing on a day-to-day, week-to-week basis. This will give you a little bit more insight as to where that money is flowing and maybe where opportunity resides. As it relates to healthcare, Brent, I think for a lot of traders, the next move is the move through resistance. If you get a move through this white line up here, traders are going to start to feel a little bit more optimistic about healthcare and a little bit more willing maybe to expose some more funds there.
Yeah, so we're either going to start to see a break of moving averages or a break of the resistance because they're going to
Yep.
converge there. So there's the bullish or the bearish technical move on that.
Yeah, one way or another, that much we know. Now, Brent, there's been some, I had some upgrades today that I wanted to bring in here to the table. A couple of these are some companies we're probably a little bit familiar with. I'm going to lead us briefly with FedEx that got oops, if I can get my symbols correct here. So FedEx was upgraded Let me just give you the specifics on it. Upgraded to overweight from neutral at JP Morgan and a new target, Brent, at 432. That's only about a 20-point premium from where we are, so about 5% or so. But Brent, on a weekly chart, on a daily chart, that is a bullish trend here.
Yeah, and it's also probably not surprising given, that we've seen some upgrades in terms of like forecasts for the S&P 500, especially as they were related to earnings growth. Well, hey, if the economy is strong, generally stocks like UPS and FedEx and those that, transportation type companies, they tend to do well too. And so maybe not surprising that we got an upgrade there.
Maybe not. And, I think the most of this trend probably resides in this channel here. What do we call it? So 342 to 392 ballpark, about a 50-point range could give you somewhere in the neighborhood of maybe 440 on a so-called measured move, but by no means a lock in any way to be achieved, but one way that some traders might evaluate the move in FedEx here. There was also an upgrade, Brent, in little company, you might have heard of them, SanDisk. They've been on an abject tear, of course, moving to the upside with aggression. Now, today you're getting a new high, but it's bleeding down into yesterday's candle, but they were upgraded at Barclays to overweight from equal weight. Get this target, Brent. They kicked it up from 1,200 to 2,300. So 800 points, a 50% premium to where we're trading right now again, but that 20-day moving average for a lot of traders has just been a magnet for support.
1,200 when they've almost doubled their target price on that. That's a big upgrade, but I guess better now than later if it continues to go up. So good trend and kind of a flag consolidation type pattern. Break above that as we're looking at it.
Yeah, and honestly, I know it's not all SanDisk, everybody. SanDisk is the one we got the upgrade on today, but let's just look at Micron, which has also been, of course, something that many traders are eyeballing here. The lunacy continues. I call it lunacy just in the speed and exuberance of the move, Brent. There's nothing from a technical basis that you would look at that says, well, this shouldn't be doing what it's doing. We have confirmation in a number of key areas. The first of which, Brent, look at the volume we're talking about here. I mean, the volume in this move to the upside is enormous. This is not, and I can validate this with my average volume details here. So let's put average volume in and let's put that over an overlay on this traditional volume so we can see the horizontal line. Brent, all of this volume is through the 50-day average. That is not a small development. That tells us that traders far bigger than you or I are devoting dollars to a massive position.
Yeah, a lot of money. You have to. You can't get this big a move in these big companies without a lot of institutional money going into those. And this is interesting. We just saw SanDisk, which was up at I think $1,200 or something. We're at $900. We're going to start seeing splits on these companies here because
perhaps
getting near the $1,000 mark, you start to see more splitting of share prices.
Yeah, it's a common view. A lot of companies look to take advantage of these moves. They also might look, now I'm not sure of Micron's balance sheet, but they are a much more mature company than many of these smallers, and that therefore they might not need any income generation by which they would, have a bond offering or anything like that, which can commonly happen in these big moves, right? Especially with those companies that are still fledgling as they need dollars to do their business or expand. That probably doesn't quite apply to Micron the way that it would to a small cap company. But that said, any shift here in the underlying business would change, but the big thing here is there's just not the demand for what Micron is offering is absolutely enormous. And that's why you're seeing so much upside, so much movement to the upside. Spikes are big, pullbacks are big. Know your levels, pay attention to your levels, know where you want to take the trades. I mean, Brent, it's not to say that we know anything about trend other than, hey, well, look at this. We had resistance at 815 and 820, and as soon as we took that out, this thing rallied 175 points from there yesterday, Brent. I can't say because of that move, but once you got through here, it was obvious that bullish traders believed there was a trade.
It's the same technical the basics of technicals that we've always talked about. Trend, support, and resistance are the biggies. And so when we look at that and we see resistance breaks and we see trends up, doesn't matter the stock, the interpretation is the same in that regard.
Yeah, and that's one of my favorite things about technicals, Brent, is that we know the stuff that we talk about on the daily chart, we can apply it to the weekly, we can apply it to the hourly, we can apply it to the 1 minute. The time frame matters because we trade various different time frames as traders, so it matters to us individually. But it also matters to the stock because remember, the longer your time frame, the more reliable it becomes. The shorter your time frame, the less reliable. So that's why that 1 minute becomes very difficult to trade on the chart, but a weekly pattern becomes much more easy to spot and stick with in many cases. And I think the weekly on Micron is about as boy, that is a sharp move. Unfortunately, we're at time, Brent. I know we covered quite a bit today. Lots to get to in this market, of course, but as always, love having you on a Wednesday. Thank you so much for sharing thoughts, sharing insights with all of our viewers today.
Hey, thanks for having me, Kevin, and thanks to each of you for joining us today, and thanks to Barb as well.
Absolutely. Big thanks to Barb. We always appreciate Barb's ability to manage the chat there. Yeah, we should all let JB, we should ask JB about MU. Is it too high? I know that's one of his favorite questions to reply to is a stock's price too high? Because the answer is very frequently, well, it can always go higher. But with that, we're going to wrap it. Thanks for being here, everybody. As always, we appreciate you. Thanks to Barb. Take an opportunity to follow us on X. Hit that thumbs up button for us down below. And as always, keep it tuned right here to the Schwab YouTube channel. So have a great day, everybody. We'll see you again real soon.